Welcome to this video where we'll teach you how to use your calculator to calculate the present value of a bond issued at par and what that even means. Make sure before you start that you grab your calculator. You remembered to get your calculator, right? This calculator, the big one, is the one I use for this class. I do not use this other one. It's called an HB12C. If you want to pretend like you're old school, right? It's kind of like a retro calculator to use, and some people really like that kind of like, oh man, I'm retro, I'm into it. If you're into that, that's fine. You're just not going to get any guidance from me. I focus on using this one right here, the BA2 Plus by Texas Instruments. It's pretty cheap and it's pretty intuitive once you figure out the lay of the land. It's a bond. We talked about this in the prior video, some of the features. This was an example from the Ford Motor Company. This is a bond issued with a par value of $5,000 and 8 1/8 percentage. You'll notice the coupon rate here, and you'll notice the coupon rate here, and then the face value of the bond a little bit higher. This is my first time using a green screen. Let's see if this worked. I think my head will be right in the way. This was another bond by the Dow Chemical Company. The face value on this bond was $1,000 and the coupon rate of interest was 7.625%. All right. And then this is an example from Australia that issued this bond. It has a face value of $20 and a coupon rate. And what I like about this as an example, it actually has coupons. These are the coupon payments. And this kind of is more physical, so it's a little bit easier to understand. These little payments right here, the little payments at the bottom, these coupons are things you cut out and then you send in and then you get the money back. You don't do that now because we're in this digital age, but that's what you used to do back in the day, back when there was this thing called paper. We talked about this in the last video. So the question is, when you have this, what's this worth? All right? Some of you might say, oh, it's worth $20. Well, that could be the case. How risky is Australia? Is it worth 5.25%? Are they more risky or less risky? Let's imagine there was like a large pandemic and the epicenter was Australia. A lot of people would probably have some problems trading there or traveling there. It might ruin some business. It might be a riskier place than 5.25%. You might have to have something a little bit more to expect payment back. And so the reality is that this contract, this piece of paper can take on a lot of different values based upon the risk of the issuer and the set of cash flows. So the point of today is to figure out how to use your calculator to determine the value of this piece of paper. So let's get your calculator. To start, we'll talk about each one of these buttons, all right? So this first button right here, this is future value, all right? So FV. FV is future value. Future value. And what we put in there is the amount that will be paid in the future, which in this case also starts with an F and a V, which is the face value. All right, face value. Right over here, we have payment, PMT, all right? PMT, this PMT. This payment amount is, as you could guess, that's the coupon rate. All right? The payment represents the fixed payments over time that are paid that are consistent every year, all right? This future value right here, that is the single payment that's made at the end, the principal amount that's paid at the end of the period, all right? The PV, this is the present value, all right? That's the present value button right here. There's a few other buttons. This one right here is I over Y. Again, we're not using this calculator here, so you can ignore this. I over Y. I over Y, that equals the interest rate per year. This is interest per year. And what that will equal is the market rate of interest. Whatever percentage the market says is the rate of interest, that's what we're going to put in there. And this N equals the number of periods. Oops. Number of periods. All right. And then there is a final thing that you need to learn. All right. So this calculator works just like your computer. If you were to try to get to, say, a percentage while you were typing, you don't hit 5, you hit Shift 5. Well, this calculator has a similar thing. This button right here, this second button, turns into a Shift button. And once you press it, everything that's written above those other buttons, that's what that button becomes. And in this case, above the I over Y is the payments per year, P over Y. All right, that's the payments per year. And the payments per year is how many fixed payments, how many ends do we basically have in that year. So this is payments over year. All right, and it's the number of payments. It's the number of payments per year that go into this button right here. So you hit second, and then this button right here, second, and then payments per year. You got to touch second first, and then payments per year, and then you get there. All right. And then the last thing you need to know is this right here. This is the quit button.
Whoa! Looks like when they made this fella, they forgot to put in the quit.
If you want to get to it, you got to hit second to quit. And this button underneath it, this is compute, CPT. That's compute.
The CPU is a neural net processor, a learning computer.
So those are the buttons. So let's go through an example of how we use these buttons to determine the value. Okay, so we have a few things written on here. We have this problem with the principal amount. This is the face value principal. So this is going to be what we put into our future value button. Coupon interest rate is equal to 10% and it's paid annually. All right, well, that annual lets us know the number of payments per year. Payments per year should equal 1, right? And 10% is that coupon payment amount. That equals the payment. But we don't want it as a percentage. We want it as a dollar amount, right? So what's 10% times 1,000? It equals $100, all right? So that's what we put into our payment button. Payment button is going to be equal to $100. Our payments per year is 1, and our future value is equal to 1,000, all right? The next, we have 5 years. 5 years equals N. That's the number of payments we have. And then finally, we have this right here. This is the market rate of interest, all right? And the market rate of interest is what we're going to put into the interest rate per year, all right? So the interest rate per year is going to equal I over Y equals 10%. So what does this look like in a calculator, all right? So we've got a calculator here. This is an emulator for my calculator that will look just like yours. Let's go ahead and clear out everything that was in this before. So let's clear time value and clear work, go down and clear work. And what you don't want to do is leave a calculation or some variable in the memory from a prior calculation, and you've put everything in, but you forgot that you adjusted something in that prior problem and you get the valuation wrong. You just don't want to do that. So I always do second clear time value, second clear work, just to make sure we're all set. So let's go ahead and put the values in here. All right, so future value. All right, so future value, we hit 1,000. You go to 1,000 and that goes to future value. Now we've got 4 decimal places showing here, so the decimal point is pretty far out, but that's what it is. It's 1,000 is the future value. All right. PMT. Well, we figured out our payments based on the coupon interest rate. We're going to be 100. All right. So we put 100, and then we press the payment button, and you'll see it says PMT equals 100, and then it has the 4 decimal places after. All right. We don't have the present value. We're trying to calculate that. We do have the I over Y. I over Y is the market rate of interest, and it just so happens in this problem, because it's issued at par, that the market rate of interest equals the coupon payments. So I over Y equals 10%. Now it's important that you don't screw this up here. The interest rate gets put in just as it is. Don't put it in as 0.1 or all these other things that you used to do for your other stuff. This calculator's smart. It knows that this is an interest rate, and so that's a 10% interest rate. So I over Y is 10%. All right. Then next we got to find out the number of periods. The number of periods is 5. So we hit 5 and then N, and then we're done. And so we go second quit. Now we've done all of the buttons here, and we're trying to figure out the present value. One thing that we got to remember is we got to tell the calculator how many payments per year, this P over Y thing. So we go second, and then I over Y, when we hit that second, is going to turn into, look, P over Y, what's written over it. And you notice it's already equal to 1. Let's say we needed to put a 2 in there. We'd press 2, set, and we'd go quit. But we don't want it as 2. We want it as 1. So we're going to press 1 and then enter. It makes payments per year equals that. You have to press enter or it won't work. And then you go second, quit. All right, so you're done. You figured out how to put everything in. Now we need to do the calculation. And what this problem does is once you have all of these variables, there's 6 variables involved in putting this in the calculator. And so if you have 5 of the variables, it's basically the calculator solving for the 6th for you. And it does it really quick. So once you're at this point where you have the 5 variables in, the future value, the payment, the interest rate per year, the number of payments, and the payments per year, this little shift button right here, what we do is we press compute present value. And you'll notice present value equals negative $1,000. Okay, so if you made it to this point and you didn't get that 1,000 in your calculator as the output, that negative 1,000 for the present value, you've probably already gone back and watched the videos again, tried to do the calculator again, and are really frustrated. And so this point of the video is to explain what might have gone wrong. There's a couple things that could go wrong that we didn't talk about. So there is this variable here, begin, right here. We quit this out, second BGN. You see that right up there, that BGN? That means for beginning of period, right? So you have to tell the calculator if it's going to be paid on the first of the year or end of the year, first of the month or end of the month if it's monthly payments. All right, so if we go second begin and second enter, it will change it. Second quit. So if you do that and it says begin, we don't want it at begin. You probably, if you did second and did this BGN, we don't want it at begin, we want it at end. And so the way you change that is you hit second, enter while it's on that BGN, second quit. And watch, we go back, it says second BGN, it goes end. So that's usually where people go wrong in this. Go ahead, clear that BGN out, play with it. Even if it hasn't happened to you yet, be familiar with how to change that, because once it changes, it's kind of frustrating if you don't know how to figure out how to get out of there and to change it back. If you want to change the decimal format, I just started this video with it at 4,000 and kept going with it. If you want to change the decimal format, you go second and you go to that decimal, and right above it, it makes it a format. You see it says DEC equals 4. And let's just do it to the second decimal. Second, you go 2 and enter this, so it'll go out 2 decimal points, and that's what it'll show you. And then I'll go second quit. So that's how you reformat the decimal. So why does this equal negative 1,000? Well, let's think about it. What this is telling us is that if you want to have that $100 of payments and that future value of $1,000, you are going to have to give up $1,000 right here, because our market rate of interest equals our coupon payments. So you're getting paid, you're being well compensated, evenly compensated with those coupon payments for the rate of interest the market requires. That means that your future value, that future payment, is going to be the same value as today, because all those periodic payments equal what the cost of the time is and the risk is associated with that interest. And so discounting it back, the $1,000 is equal to the $1,000 in the future because of all the payments in between. Now, why is it negative? Because the calculator knows that in order to get those positive cash flows, you have to have a negative cash flow out to get them. You have to make an investment. You have to buy something that gets those positive cash flows. And so when you put positive numbers in on those, the payment and the future value, it knows that it'll be a negative 1,000. And you usually don't put the negative when you're doing the value, when you write the answer down of the value of the bond on the market will pay $1,000 for this bond, and that's what it is. You don't need to put the negative in front of it. The negative just lets you know that it would be a cash outflow. So that's how you do a bond issued at par. All right, so what we're going to do in the next video is we're going to go through the journal entries for multiple periods related to for a bond when you issue a bond as a corporation. Okay, so we've gone through how to use the calculator
and how to get to the answer. And we figured out the present value equals 1,000. That means when we went to the market and sold the bond, we got $1,000 in cash for issuing this contract with the fixed payments, not the fish payments, the fixed payments into the future. Okay, so what's the journal entry for this? How do we journal entry for the issuance of bonds? So if we start off with our standard balance sheet, which is it's a par value bond. It was issued at par, so par equals present value. And on day one, that first period, let's say it was January 1st, what happens when we issue the bond? Well, start with the things that you can touch first. First, we got cash. We're going to debit cash. Debiting cash increases our cash for our assets. So we have $1,000 in cash, and we're not done. We have to figure out what's the corresponding entry. And you only got a few options. It could be a credit to assets. That doesn't really make sense. What you really have is a liability. This is just like a loan. And this is the credit that we're going to use. This one right here. So we're going to credit liabilities, and we're going to call it, let's call it bonds payable. Payable for 1,000, right? And this is the journal entry you would have on day one when you issued that. So what does that look like in the standard journal entry format? Well, the standard journal entry format would have a debit, cash, and then a credit, bonds payable for 1,000. Right? So that's the first journal entry. That's period one. All right. So at the end of the year, we have interest payments on this. Remember, the market rate of interest was 10%, and that just so happened to also equal the coupon payment. Cash going out, we have to pay what that little coupon thing on the bond, we have to issue a check for that coupon payment. So it's going to be, in this case, cash of 100. Right? So this 10%, that one right here, this 10% times 1,000 gets us to that 100 right there. All right. So that's what the cash is. That's how much cash that we paid, the $100. All right. So that's going out. So we have, we're going to have a credit of cash in that period, credit cash of 100. Okay. Now we have to figure out what's going to be our debit. What is on that debit side? We have a credit and we have a debit that we need to balance out. Well, we do know we do have an interest expense. All right. Interest expense is from this market rate, right? And so to get there, we have this market rate, this 10%, and it's also times 1,000. Now you're going to say, oh, I can just shortcut this and always use whatever the market rate, coupon rate. It doesn't matter. It doesn't matter if it's a bond issued at par. It does matter if it is a bond issue at a premium or a discount. There's a reason why we're starting with this one. So this is also equal to 100. And so our interest expense, debit interest expense for 100. Right? So our interest expense is 100 and our cash is for 100. So debit, credit, and the debit would go here on our income statement, interest expense of 100 right there. And that's what we do. And the reality is we'd have that payment. We'd do that journal entry for not only year one, but year two would look exactly the same, just ditto, like same thing as above for year 2, 3, 4. And then on the 5th year, the final year, what we'd have is we'd have something a little bit different. In that final year, we'd still have our interest expense for 100, and we'd still have our cash of 100, but we also are paying our bonds payable. So in addition to that cash coupon payment related to interest expense in period 5, we're also going to have the cash of the 1,000. So you go credit and you go cash, and you just combine the total cash payment that you're going to be making, which is 1,100, and you have a debit. All right. And one of those debits is interest expense of 100. And then the other debit that we have is this bonds payable. This bonds payable, I'm I'm going to put it on the other side of this line right here. Other side of this line right here. So this bonds payable is going to go from that balance is going to end up being, the account's going to be debited. So bonds payable. All right, so this is a really ugly entry. Forgive me for running out of space. Bonds payable for 1,000. Boom, right there. And this is what it'd look like on your entry. Bonds payable 1,000. And you'll notice our debits equal our credits. We have 1,000 and then we have 100 equals to the cash payment of 1,100. And that's what we would do in our 5th year. All right? Years 1 through year 4 would just have this entry up here, this entry right here. Year 5 would be this entry, and this is when it's issued. So that is how you journal entry for a bond issued at par. Now, there's different things that happen at different times, and there's a fair amount that goes into the calculation, but after you do a few of these problems and following these steps, it'll become pretty intuitive to you. So I recommend you going back and watching the video, making sure you understand where all the buttons are on the calculator, and then understanding how these things fit into the balance sheet. When the cash comes out, what gets recorded in the liabilities, and then what ends up on the income statement. In the next video, we're going to challenge you a bit more. We're going to do bonds issued at a discount and at a premium, all right? And the journal entries get pretty tricky there, but the more you get grounded in this, the easier that'll be.
Oh my gosh, I am so, I'm exhausted. I'm so exhausted.